Robschild, no investment advice. Welcome to the show where we view financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Tuesday, January 28th, 2025. Today's episode begins with DeepSeek works well at 1/10 the cost of ChatGPT. I am not the only person apparently to try to download it and log in for the first time yesterday when all this news was happening, and I couldn't get in. Finally, I got in and got to use it today and watched a few reviews on it, and apparently, yeah, it's legit. This isn't some kind of scam. The thing works a lot better than ChatGPT at 1/10 of the cost, and it's amazing. And it does beg the question, how much more AI has been priced to be 10 times as expensive as what the cost will eventually be. I mean, and it could even go further than that. We'll have to see the longer term future of this. But, at the end of the day, yeah, we're making plenty of chips. That's my big thing with the semiconductor industry. And I would suspect that the semiconductor industry would continue to fall from here in its stock valuation. It would make sense, but Mr. Market can do whatever he wants. We'll see how long it takes for that to play out. Not a ton of super interesting market action today, so I wanted to bring up the history of dividend payments. I've brought this chart up before from multpl.com, the S&P 500 dividend yield going back to 1871. This chart represents what you would have gotten in dividend payments from essentially the S&P 500 for the past 150 years. If you were to buy SPY, for example, in 1950, you'd be getting a 7% dividend yield, at least momentarily in 1950. But averaging probably, between 4 and 5% has been normal for most of history. And then in the 90s, we had it drop to a low of 1.17%, and then going as high in 2009 to 3% when stocks got really cheap. And now we're currently today at a level of 1.23%. This is near record lows of what you can get in terms of what are companies paying out from their profits to their shareholders. Now, granted, the excuse for dividend yields being low involves the fact that, yes, it's good for companies to use their earnings in order for the company to make more money, but companies don't always last forever. We've seen tons of enormous companies lose all of their value, and the people just happily sitting on their hands, while the company is continuing to keep all of the money and spend it on new, better projects. It doesn't always pan out. And I am wondering if, we are in really, right now, the greatest stock bubble of all time. Partly because of this. What happens when people start to realize, hey, why are treasury bonds, yielding 4.5% and the S&P 500 yielding only 1.23%? It was I think it was 1955, I saw an interview with Benjamin Graham, and people were discussing if stocks were getting overvalued at that point, because of the more recent, depression where stocks were so cheap for so long. And he was laughing because at that time, stocks were yielding, the dividend payment on the S&P 500 was higher than what you could get on a U.S. Treasury bond. And we're in such an incredibly opposite position today that it just adds to the very strong case that I find stocks generally, especially U.S. stocks, especially mega cap stocks, to be enormously, outrageously expensive right now. And I do think it's still going to blow up, and it's going to be really bad. A question I think I'll put out there onto the internet: How low can the S&P 500 dividend yield go? Right now we're at 1.23%. The previous all-time low looks like it was at 1.17%. You tell me in the comments. How low can you go? Next item on today's agenda, Wednesday, we have the FOMC meeting. This is widely expected to be the first no-cut meeting. If you remember September, there's no meeting in October. There was the September that had the double cut, the 50 basis point cut, and then November, another 25, December, another 25. Although, if you remember leading up to the December report, it was like we weren't sure what was going to happen. This report is literally tomorrow, and there is zero expectation of a cut tomorrow. So there probably won't be one. The more important thing we're looking for here is what they may say as to what may be occurring in the future. As it stands, we recently went from only one cut basically for the foreseeable future to 3 more cuts priced in now to the Fed funds futures. So it's like, based on this alone, it's likely for them at the FOMC meeting to announce, that they're going to follow basically the path of the Fed funds futures, which, they go in lockstep with each other usually. So, but we'll see. It could be a big day tomorrow, hard to say. Very notably, Thursday, GDP of quarter 4 2024 comes out. This could actually be a huge rocking the boat kind of thing, as I said yesterday as well. If it's below 2% or, significantly below 2%, maybe even negative, that's like, okay, it's actually a recession now because we have negative GDP. Well, I'm looking forward to that report hugely. And then Friday we have the PCE data, the Fed favorite gauge of inflation, the personal consumption expenditures. Before we move on to the charts, the daily reminders, no major changes as of today. I will be doing another macro update some point soon, but the latest one where I read through it is 1:10:25, dominoes in the ball. In that episode, I also explain my crystal ball ratings and my portfolio. The first chart I actually want to bring up today is the history of the Fed funds rates. This is on tradingeconomics.com. It goes back to 1971. As you can see in this chart, I wanted to bring up a specific time period, the 90s going into the dot-com bust. We had this period of hiking, 1 cut, 2 cut, 3 cut, 3 cuts, pretty close to each other, before pausing, raising, and then a few more cuts, and then raising straight into the dot-com bust, where we had to aggressively drop rates all the way down from 6.5% to 1%. With the current pause in the FOMC meeting tomorrow, one wonders if we are repeating the late 90s and that, this will extend maybe even several more years before the eventual AI bust. After all, market bubbles can get bigger. They can get a lot bigger before they burst. I personally don't like investing in things that are clearly overvalued. And, my strategy does not involve chasing momentum or relying on a Ponzi scheme, relying on other people to pay a higher price than, what someone paid yesterday without the value to back it up. So, as much as I can foresee this being a potential outlook into the future, I still like my own strategy. And my biggest reason for being so bullish on treasury bonds compared to the S&P 500, for example, is the earnings of the S&P 500 versus what you can get on AA corporate bonds. The difference of return on those two investments is so enormously different that it just makes a lot more sense for me personally to be in treasury bonds at this moment. But again, watch the 1:10:25 show to hear me fully explain all of that. First chart of today, S&P 500. All I can say is moving sideways. This is nor bullish nor exactly bearish. We had a huge crack in the market off of this news that we might not need as many semi-chips as we thought we were going to need. That was the news, and markets reacted very strongly off of that. And the S&P 500 bouncing solidly back up today. It's interesting, not all indices are reacting this way. The Russell 2000, the Dow Jones, I think, is just hitting a double top right now. The reason the S&P 500 is doing this is because of the large amount of speculative price, I'll call it, in the semiconductors and other companies involved with AI, and so that's why the S&P 500 itself is going a little wild here. All I can say about, moving forward from here, I won't be surprised to see it go way up or way down. I don't know where Mr. Market is going to drive his car from here. But the FOMC meeting may send things going wild, as well as Thursday. That GDP report could, really rock the boat. The VIX caught my eye today. The fear index, the pricing of options contracts, although it dropped by 8% today, I will say it didn't drop to where we were before. And so there's a chance that we may see the VIX spike up here again. FOMC meeting and the GDP report and even the PCE index. We have a lot of data the rest of this week that could really rock things one way or another. And this is all on top of, geopolitical things going on. If you've been watching the news, things are getting crazy everywhere, it seems, not just in financial markets. TLT, my favorite place to be. The way that I'm looking at this now, let's get rid of this line here. So I've been talking about the 10-year note yield having this head and shoulders. I'll bring that up in a second. We broke through the neckline yesterday, same on TLT, the exact opposite. And, we touched it today. This is like a perfect setup for TLT to continue higher. Equally, its inverse TNX, the 10-year Treasury note yield, doing the absolute perfect opposite, upside down version. We cracked through it. We tested it today. It's very likely the 10-year note yield wants to go lower very clearly. We'll see what happens. Oil finally getting a green, a larger green candle, although it's still inside of the previous day's red candle. This is definitely not looking bullish, but maybe pausing, maybe we'll put in a base here, or maybe we even may have, your head and shoulders top here. This could be the other part of the neckline before we crack down and come back to this epic trend line that we've been bumping along for forever on. Certainly if the GDP report was to come in negative on Thursday, that could send oil straight through that bottom line, $67 in my opinion. The index running the show right now, the semiconductor index SMH ETF, getting a little bounce today. This does not look like a blow off bottom. If we were going to have a blow off bottom, we would have had much stronger buyers here, and we would have driven the price up substantially. Instead, we have this little tiny green candle from open to close on the inside of yesterday's candle. This suggests to me that this market still wants to sell off. K-Web, the holder, the ETF, the Chinese ETF of the Amazon, Facebook, all the internet companies, but the Chinese versions of them, very notably hitting from this top in October to the top in December, hitting that same exact line today. I'm very curious if, with China's good news on DeepSeek, if people are going to be more interested in making Chinese equities have a little bit more normal valuations. Again, this fund makes sense to me around the $50 range, which is where I would sell if we get there. Last chart of the day from the Fred website, the 10-year break-even inflation rate. This chart says what the market is currently pricing inflation to be. It doesn't matter what your uncle says, what the news people on TV says, what this YouTuber says, what that YouTuber says. If inflation is going to the moon, if we're headed into deflation, this is priced. People are betting on this. If you want to, know where the odds are, take a look at where the money is. And we are going sideways here, sort of coiling up in the 10-year break-even inflation rate. We had recently been going sideways for a long time and then peaking at 2.45 and more recently consolidating. With the rest of the data coming out this week, I do expect this to either break to the upside or to the downside. I'm not really sure. However, my crystal ball says it's going to be going to the downside, and that's all from me and my crystal ball, and I hope you enjoyed, and thank you for watching, and see you next time. Robschild.